Okay, so welcome to my video where I'll be talking about auditing of fair values and financial assets and the role of auditing in the financial crisis. The learning objectives for this class are as follows. First of all, I'm going to talk to you about the financial crisis of 2008 to 2009, and I'll discuss the role of auditing and financial misreporting in the crisis. Secondly, I'm going to talk to you about the appropriate accounting for debt securities and what are the risks to auditors when they audit debt securities. Then we'll move on to financial assets without readily determinable values. So we'll be talking about level 1, level 2, and level 3 inputs and how those are used to derive values, fair values for the financial assets. Then we'll think about describing the audit procedures for assessing fair values for these hard to value financial instruments. And then to wrap up the class, we'll talk about what went wrong in the audits at AIG and Lehman Brothers, which were two financial institutions that were heavily involved in the financial crisis of 10 years ago. Okay, so the learning objectives for today's seminar are shown here in the seminar outline. I've just mentioned them as well on the PowerPoint slide. The reading, you should have a look at the class questions on the seminar outline. I have a video interview with the bankruptcy examiner of Lehman Brothers. So you should watch that because we're going to have a talk about the Lehman Brothers case. Then there's a video that I'm doing right now where I'll talk about auditing's role in the financial crisis. Question 2 on your seminar outline is about a PCAOB inspection report that was issued to PricewaterhouseCoopers in 2011. Okay, and PricewaterhouseCoopers was criticized in that report for the way it had audited financial assets. So that's why it's relevant to today's topic. I've provided here a link that will help you to answer question 3, which is about credit default swaps. And the reason I'm asking this question for question 3 is that you need to understand what credit default swaps are when we move on to talk about the AIG case. And then there's also some reading here that are provided on repos. Those are repurchase transactions. That's helpful for question 4. And the reason I'm going to be talking to you about repos is that it's necessary for you to understand repos, what they are, when we come to the Lehman Brothers case. Okay, so that's the required and recommended and optional reading and viewing for you before the class. The questions we're going to talk about in class, question 1 is about debt securities. Okay, so how does the accounting for debt securities differ depending on whether the security is held to maturity, it's a trading security, or it's an available for sale security? And then once we've talked about that, we're going to think about how the audit risks are different between those 3 different types of security. Question 2 is about the inspection report that PwC received in 2011. Pages 17 and 18 discuss some audit deficiencies that the PCAOB inspectors found with the way financial securities without readily determinable fair values had been audited. So that's question 2. Question 3 is kind of a segue into discussing the AIG case. So to understand the AIG case, you have to know what a credit default swap is. So we'll cover that first of all. And then we'll discuss why should the seller of a credit default swap monitor the default risk of the underlying borrowers. Okay, so that's with respect to AIG. And then we'll discuss the Lehman Brothers case. And before going into the Lehman Brothers case, you need to know what a repo transaction is and how the accounting works for repo transactions. So that's covered in question 4. Right? So what is a repo? How do companies normally account for repos? How does the initiation of a repo transaction affect the bank's reported leverage? Okay, so we'll cover that. And then once you have a good understanding of this background material, then we can kind of go in and better understand what happened in the Lehman Brothers case. Okay, so let me start off by talking to you about the financial crisis and the role that auditing played in the crisis. So the financial crisis from 10 years ago was very severe, perhaps not quite as severe as the most recent crisis during the coronavirus pandemic, but you know we're still doing research on that. We don't fully understand what the ramifications of the COVID panic will be. But in terms of the financial crisis, it was certainly very severe. So, for example, the Dow Jones index fell from 12,000 points to 6,600 in the space of less than a year. The number of corporate bankruptcies tripled from 20,000 in 2006 to 61,000 in 2009. A lot of people lost their jobs. 3.6 million jobs were lost in 2008. Another 4.7 million were lost in 2009. And, you know, these numbers don't really tell the whole story, because behind these numbers are, you know, real people, real lives, you know, and there was a very significant human cost. So those sharp increases in stress, steep declines in life evaluation, and, you know, that led people to commit suicide and, you know, suffer all sorts of problems as a result of the economic crisis. Okay, so that's just kind of a bit of background in terms of the severity of the crisis. So what was the cause of the financial crisis? Well, when President Barack Obama decided to look into this, he set up the Financial Crisis Inquiry Commission to look at how the financial crisis occurred. You know, the attempt was to learn lessons so that, you know, such a crisis would never happen again. There were 5 reasons put forward by the commission. So I'll first talk about those reasons, and then I'll talk about the role that auditing and low quality accounting also had to play. So the first explanation for the crisis was that there's a sharp deterioration in mortgage lending standards. Okay, so in other words, the financial institutions that were selling mortgages were giving mortgages to people who really were not in a position to be able to service the loans. Okay, so there was a lot of high risk borrowing. And this is even noted in the names that were given to the mortgages. Right? So the mortgages were known as sometimes low doc, meaning low documentation. The borrower didn't have to provide much documentation for the mortgage. There were no doc mortgages, where there was absolutely no documentation provided. And then there were also mortgages called ninjas, right, which stands for no income, no job. Right. So obviously this kind of person, if somebody doesn't have an income, doesn't have a job, that's a very high risk kind of borrower. Okay. So there's a big deterioration in mortgage lending standards. A lot of high risk people were able to get multiple mortgages in some cases. This was fueled by a huge increase in mortgage securitizations. So these mortgages would be packaged and then sold off as another asset. Okay. And so this is known as a securitization. When you put together a package of mortgages and you sell it off, that packet is supposed to manage risk, right, by pooling the default risk across multiple mortgages. And then the securitized mortgages were then being sold off to other financial institutions. But part of the problem here was it's very difficult to value these securities. And because of the difficulty in valuing, it gave managers a lot of discretion in how to value these financial assets. And that led to managers overstating the values of the underlying assets, or equivalently understating the default risk on the mortgages. Okay, and they did that partly because by overstating the values of the mortgages, they were able to get higher compensation. Now, this also feeds into the third point, which is about the failure of risk management of the financial institutions. So the financial institutions became very highly indebted. Okay. So some of the banks had leverage ratios of about 40-1, which meant that a small drop in the housing market would leave them being insolvent. And some of the most highly leveraged institutions were Freddie Mac and Fannie Mae. These are government-led institutions who were involved in lending to low-income individuals who normally wouldn't be able to get a mortgage, and their leverage ratios were exceptionally high, around 75-1, which is why some people blame the government for the financial crisis, right, by expanding the amount of lending to people who couldn't really afford to service their mortgages. So that was the third reason. And then the fourth one is poor quality credit ratings. So when these mortgages were securitized and then issued to investors, the issuer would get a credit rating, but it would be the issuer who would pay the credit rating agency for the credit rating. And credit rating agencies are competing for business, similar to auditors. Auditors are competing for business from clients, and the clients pay the auditor. It's the same kind of conflict of interest with credit ratings, right, where issuers are paying the credit rating agencies for the credit rating. And so, what happened was that some of these financial institutions went bust with holding assets whose credit ratings were greatly inflated. And then the final point is about the failure of regulators to oversee the financial system. So there are a couple of issues here. One was that regulators just didn't understand what was going on in the background. That was part of it. But then the second issue was that there were multiple regulatory agencies. And so in some cases, it wasn't clear who was responsible for regulating which part of the system. Anyway, that's just a very brief overview of what the Financial Crisis Inquiry Commission concluded in terms of what the cause of the crisis was. But what I want to do in today's class, given that this is an auditing course, is I really want to focus on the role of auditing and accounting in the crisis. Now, I'm not trying to claim that auditing and accounting were the major causes of the crisis. They weren't. They had a relatively minor role, but nevertheless, they did still play a part in the crisis. Okay, and this is what I'm going to emphasize in the following discussion. Okay, so to investigate this, what I did, this is some data that I put together in some research that I did. What I looked at is the incidence of accounting litigation for financial and non-financial firms, where the lawsuit is claiming that the firm financially misstated their accounts. Okay, so I've got data here from 2003 to 2011, and what these dates basically show is the period in which the misstating occurs. Okay, so for example, just over 3.5% of non-financial firms, those are the ones shown in blue here, okay, just over 3.5% were misstating their financial statements, resulting in litigation subsequently. Okay, so those misstatements were occurring in 2003, Q1. All right, and so what we've got here is kind of a pattern of misreporting, right, for financial firms compared to non-financial firms during each sample quarter, going from 2003, the beginning, to the end of 2011. So what can you see? Well, generally speaking, there's a downward trend, right, in financial misreporting. So in the US economy as a whole, right, accounting seems to be getting better, right? It's generally trending downwards. There are fewer misstatements and fewer accounting lawsuits. So that's the good news. But the bad news is that for the financial firms, there was a major hiccup around 2006 to 2008. And so that's what you can see here with this red line here. Okay, so you can see that in most years before 2006, most quarters, the financial firms have actually lower rates of misreporting compared to the non-financial firms. And similarly, from 2009 onwards, financial firms have a lower rate of misreporting compared to the non-financials. But during this period, 2006 to 2009, this is when the financial firms were engaged in a lot more misreporting, right? You can see this goes up here relative to the blue line for the non-financial firms. And this is basically the same evidence, but just in terms of the percentages. So these are the percentages that I'm showing you in this diagram. These are for the full sample, so it's the financial and non-financial firms, the non-financials and the financial firms. Okay, so what I've got here in the right column is the difference in the percentage. In other words, what's the vertical distance between these two lines in each quarter? Okay, and I have t-stats for each of these differences. All right, so what we can see is that generally speaking, we've got negative signs on the t-stats in the period from 2003 to 2006. Not many of them are statistically significant. And then from 2009 onwards, again, it's negative, but not generally statistically significant, except for a couple of quarters here and here. But the key thing is in this period from 2006 to 2008, this is when we see the t-statistics being positive, and they become highly significant from the end of 2006 through to the end of 2007. Right? So in other words, if we look at this period here, 2006 to 2007, this is a significant difference between the financial and non-financial firms. So the overall takeaway from this is that it looks like the financial firms were involved in more misreporting during this period. Okay, so there is a role for financial reporting and auditing, right? That did play a part in the crisis. So let me give you some notable examples of financial institutions that were sued as a result of misreporting. So these are the largest 6 cases in my database. Okay, so the largest financial institution that was sued was Citigroup. The payout to the plaintiffs in the lawsuit was $1.3 billion. In that particular case, the audit firm was not sued, but in 4 out of 6 of these cases, the audit firm is being sued. Okay, and I have on the right-hand side the amount that was paid out by the audit firm to the plaintiffs. Okay, so in the case of Countrywide, for example, the total payout from all of the defendants was 1.124 billion. KPMG was one of the defendants, so KPMG was sued, and KPMG's contribution to the payout was 24 million. Okay, so most of the payout you'll see 1.1 billion that came from other parties like the company's managers, company's shareholders. So most of the payout is coming from those parties rather than from the auditor, but the auditor is still often being sued, and these are the amounts shown here. The largest case you see is the Lehman Brothers case, largest for auditors, I mean. The auditor of Lehman Brothers was Ernst & Young, and Ernst & Young had to pay 99 million of the 775 million as a payout to the plaintiffs. Okay, so this gives you a sense of the biggest cases, right? How much did the company have to pay out? The company, its managers and auditors, how much did they have to pay out, and what was the contribution of the auditors, if any, right? Okay, so that's where I will stop talking. What I'll do now is add on to this video a video from a couple of economists that give you a bit more background information about the financial crisis. Okay, so I'll add that video on here, and then when this video is finished, we'll then, in the class, we'll move into question number 1, where we'll look at the accounting for debt securities and how these different types of securities pose different types of audit risk for the auditor. Okay.
Welcome to Crash Course Economics. My name is Jacob Clifford.
And I'm Adrienne Hill. And today we're going to do something a little different. We're going to explore one moment in history in depth. We're going to talk about how the 2008 financial crisis happened and the government response to it in the United States.
So let's get started. The 2008 financial crisis was a big deal. Ben Bernanke said it could have resulted in a 1930-style global financial and economic meltdown with catastrophic implications. But what happened? Why did it happen? And why aren't we all huddled around burning trash cans, forming a raiding party to go steal gas from other tribes in the wasteland? By the way, if you're actually doing that, you probably didn't hear we survived the financial crisis. Things got better. Seriously, put down your crossbows.
To explain what happened, first we have to do a quick explainer about mortgages. And you might already know this, but basically someone that wants to buy a house will often borrow hundreds of thousands of dollars from a bank. In return, the bank gets a piece of paper called a mortgage. Every month, the homeowner has to pay back a portion of the principal plus interest to whomever holds the piece of paper. If they stop paying, that's called a default, and whomever holds that piece of paper gets the house. The reason I'm saying whomever holds the paper rather than the bank is because the bank, the original lender, often sells that mortgage to some third party. And the reason I say often is because this happens all the time. I've had my house for 9 months and 3 different banks have had the mortgage. Traditionally, it was pretty hard to get a mortgage if you had bad credit or didn't have a steady job. Lenders just didn't want to take the risk that you might default on your loan. But all that started to change in the 2000s. And before we go further, a quick aside here. The story gets complicated fast, and it's a fascinating story, but we're trying to keep it relatively simple. So I've asked Stan if we could put some additional resources in the YouTube description. And Stan said yes. Thanks, Stan. Anyway, back to our story. In the 2000s, investors in the US and abroad looking for a low-risk, high-return investment started throwing their money at the US housing market. The thinking was they could get a better return from the interest rates homeowners paid on mortgages than they could by investing in things like US Treasury bonds, which were paying very low interest. But big money global investors didn't want to just buy up my mortgage and Stan's mortgage. It's too much hassle to deal with us as individuals. I mean, we're pains. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities are created when large financial institutions securitize mortgages. Basically, they buy up thousands of individual mortgages, bundle them together, and sell shares of that pool to investors. Investors gobbled these mortgage-backed securities up. Again, they paid a higher rate of return than investors could get in other places, and they looked like really safe bets. For one, home prices were going up and up, so lenders thought, worst case scenario, the borrower defaults on the mortgage, we can just sell the house for more money. At the same time, credit ratings agencies were telling investors these mortgage-backed securities were safe investments. They gave a lot of these mortgage-backed securities AAA ratings, the best of the best. And back when mortgages were only for borrowers with good credit, mortgage debt was a good investment. Anyway, investors were desperate to buy more and more of these securities. So lenders did their best to help create more of them. But to create more of them, they needed more mortgages. So lenders loosened their standards and made loans to people with low income and poor credit. You'll hear these called subprime mortgages. Eventually, some institutions even started using what are called predatory lending practices to generate mortgages. They made loans without verifying income and offered absurd adjustable rate mortgages with payments people could afford at first, but quickly ballooned beyond their means. But these new subprime lending practices were brand new. That meant credit rating agencies could still point to historical data that indicated mortgage debt was a safe bet. But it wasn't. These investments were becoming less and less safe all the time. But investors trusted the ratings and kept pouring in their money. Traders also started selling an even riskier product called collateralized debt obligations, or CDOs. And again, some of these investments were given the highest credit ratings from the ratings agencies, even though many of them were made up of these incredibly risky loans. While the investors and traders and bankers were throwing money into the US housing market, the price of homes in the US was going up and up and up. The new lax lending requirements and low interest rates drove housing prices higher, which only made the mortgage-backed securities and CDOs seem like an even better investment. If the borrowers defaulted, the bank would still have this super valuable house, right? No, wrong. Let's go to the thought bubble. Actually, let's go to the housing bubble. You remember bubbles, right? Rapid price increases driven by irrational decisions. Well, this was a bubble, and bubbles have an annoying tendency to burst. And this one did. People just couldn't pay for their incredibly expensive houses or keep up with their ballooning mortgage payments. Borrowers started defaulting, which put more houses back on the market for sale. But there weren't buyers, so supply was up, demand was down, and home prices started collapsing. As prices fell, some borrowers suddenly had a mortgage for way more than their home was currently worth. Some stopped paying. That led to more defaults, pushing housing prices down further. As this was happening, the big financial institutions stopped buying subprime mortgages, and subprime lenders were getting stuck with bad loans. By 2007, some really big lenders had declared bankruptcy. The problem spread to the big investors who'd poured money into these mortgage-backed securities and CDOs, and they started losing money on their investments. A bunch of money. But wait, there's more. There was another financial instrument that financial institutions had on their books that exacerbated all of these problems. Unregulated over-the-counter derivatives, including something called credit default swaps that were basically sold as insurance against the default of mortgage-backed securities. Does AIG ring a bell? It sold tens of billions of dollars worth of these insurance policies without money to back them up when things went wrong. And as we mentioned, things went terribly wrong. These credit default swaps were also turned into other securities that essentially allowed traders to bet huge amounts of money on whether the values of mortgage securities would go up or down. All these bets, these financial instruments, resulted in an incredibly complicated web of assets, liabilities, and risks, so that when things started going bad, they went bad for the entire financial system. Thanks, Thought Bubble. Some major financial players declared bankruptcy, like Lehman Brothers. Others were forced into mergers or needed to be bailed out by the government. No one knew exactly how bad the balance sheets at some of these financial institutions really were. These complicated, unregulated assets made it hard to tell. Panic set in. Trading and the credit markets froze, the stock market crashed, and the US economy suddenly found itself in a disastrous recession.
So what did the government do? Well, it did a lot. The Federal Reserve stepped in and offered to make emergency loans to banks. The idea was to prevent fundamentally sound banks from collapsing just because their lenders were panicking. The government enacted a program called TARP, the Troubled Assets Relief Program, which the rest of us call the bank bailout. This initially earmarked $700 billion to shore up the banks. It actually ended up spending $250 billion bailing out the banks and was later expanded to help automakers, AIG, and homeowners. In combination with lending by the Fed, this helped stop the cascade of panic in the financial system. Treasury also conducted stress tests on the largest Wall Street banks. Government accountants swarmed over bank balance sheets and publicly announced which ones were sound and which ones needed to raise more money. This eliminated some of the uncertainty that had paralyzed lending among institutions. Congress also passed a huge stimulus package in January 2009. This pumped over $800 billion into the economy through new spending and tax cuts. This helped slow the free fall of spending, output, and employment.
In 2010, Congress passed a financial reform called the Dodd-Frank Law. It took steps to increase transparency and to prevent banks from taking on so much risk. Dodd-Frank did a lot of things. It set up a Consumer Protection Bureau to reduce predatory lending. It required that financial derivatives be traded in exchanges that all market participants can observe. And it put mechanisms in place for large banks to fail in a controlled, predictable manner. But there's no consensus on whether this regulation is enough to prevent future crises.
So what have we learned from all this? Well, one key factor that led to the 2008 financial crisis was perverse incentives. A perverse incentive is when a policy ends up having a negative effect opposite of what was intended. Like mortgage brokers got bonuses for lending out more money, but that encouraged them to make risky loans, which hurt profits in the end. That leads us to moral hazard. This is when one person takes on more risk because someone else bears the burden of that risk. Banks and lenders were willing to lend to subprime borrowers because they planned to sell the mortgages to somebody else. Everyone thought they could pass the risk up the line. The phrase "too big to fail" is a perfect example of moral hazard. If banks know that they're going to be bailed out by the government, they have an incentive to make risky or perhaps unwise bets. Former Fed Chairman Alan Greenspan summed it up really nicely when he said, if they're too big to fail, they're too big.
When something terrible happens, people naturally look for someone to blame. In the case of the 2008 financial crisis, no one had to look very far because the blame and the pain was spread throughout the U.S. economy. The government failed to regulate and supervise the financial system. To quote the Bipartisan Financial Crisis Inquiry Commission report, the sentries were not at their post, in no small part due to the widely accepted faith in the self-correcting nature of the markets and the ability of financial institutions to effectively police themselves. The report placed some of the blame on the years of deregulation in the financial industry and blamed regulators themselves for not doing more. The financial industry failed. Everyone in the system was borrowing too much money and taking too much risk, from the big financial institutions to individual borrowers. The institutions were taking on huge debt loads to invest in risky assets, and huge number of homeowners were taking on mortgages they couldn't afford. But the thing to remember about this massive systemic failure is that it happened in a system made up of humans, with human failings. Some didn't understand what was happening. Some willfully ignored the problems, and some were simply unethical, motivated by the massive amounts of money involved. I think we should give the last word today to the Financial Crisis Inquiry Commission report. To paraphrase Shakespeare, they wrote, "The fault lies not in the stars, but in us." Thanks for watching. Crash Course Economics is made with the help of all these nice people. We're able to stave off our own financial crisis each month thanks to your support at Patreon. You can help keep Crash Course free for everyone forever and get great rewards at patreon.com. And given today's subject, be exuberant, but keep it rational.